Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. In most of sub-Saharan Africa, inflation eased, allowing most central banks to hold or decrease rates. This comment was among the prepared remarks delivered by Standard Bank CEO Sim Shabalala at the earnings presentation on Thursday. It was all smiles at the banking giant, with results that include the best return on equity they've achieved under the current regulatory requirements, and the best ever cost-to-income ratio of 49.4%. The African economic environment has been a huge driver of that performance, which brings me to a point that just cannot be stressed enough to investors. You ignore the macroeconomic drivers at your own peril. A further nuance is this: you refuse to change your mind at your own peril as well. Things do change out there. The risk-reward trade-off is a dynamic thing that shifts over time in response to geopolitics and macroeconomics, taking market prices with it. Nothing is good forever or bad forever, which is what keeps the markets exciting. Africa is the perfect example, having been a lucrative recovery story this year after a really tough period. But what happens if you get the macro story wrong? Well, the highest quality way to get it wrong is to simply have no position, which means you're on the sidelines while others are making money. It's annoying, but it's more than fun if your money was put to better use elsewhere. For context, much as the market is celebrating Standard Bank with a 13% year-to-date share price return, a Satrix Top 40 ETF would have returned nearly 25%. Standard Bank may pay a stronger dividend yield than the market average, but definitely not enough to close that gap in performance. And even if your money didn't beat the return offered by the thing that you missed out on, you'll drive yourself mad trying to constantly compare. Missing out on a winner is one of the guarantees of being in the market. It will happen. But the thing that really hurts is when you take an active bet on the macro and get it wrong. The sidelines might be boring, but being on the receiving end of a market whipping is far worse. Less than a year ago, MTN was facing a nightmare situation in the share price that even led to the restructuring of MTN's Akele Futhi in an effort to stop it from maturing underwater. Today, the share price has literally doubled year to date, and those same Akele Futhi shareholders who were panicking last year are probably feeling frustrated that the board elected to unwind the scheme too soon in 2025. If you were short MTN this year, perhaps stubbornly holding the view that Africa is always a place to lose money, then the market would have literally ripped your face off. Similarly, had you been long at a time when MTN and other companies in Africa were suffering, then you would also have been severely hurt. When the macro goes wrong in frontier markets, you end up with rapidly depreciating currencies and governments that are desperate to shake the tree and see if any tax revenue falls out. Goodness knows we've seen this in countries like Nigeria, claiming some major corporate scalps along the way and hurting investors. In these scenarios, although hindsight is perfect, it is better to get out of the way of the terrible macro situation. MTN's share price, despite such a huge rally this year, has actually only recovered to early 2022 levels and is still way off the peak we saw at the start of that year. MTN is the same company, but facing different macro environments and therefore generating completely different outcomes for investors now versus what we saw a year ago. Picking stocks without looking at the big picture is therefore like sitting in your car on an airport runway, facing away from where the planes are approaching from. I don't know exactly when you're going to get smashed into oblivion by something big that you chose to ignore, but I know that it's definitely going to happen at some point. It is not wise to ignore the macro when you are picking stocks. Now, the beauty of the market is that there are things available for all risk tolerances in these macro plays. If you're incredibly brave, you could do something like take a punt at SAPI, for example, in the hope of an improvement in global trading conditions and thus demand for the underlying paper and packaging products. SAPI is trading at close to its 52-week lows thanks to a nasty combination of higher debt and lower earnings. Now, it's well beyond my risk tolerance, and I'm not a fan of cyclical stocks, but there are people who make great money on these things through successful swing trading strategies and through trying to take a view on a change in the macro conditions. Now, if that's too much risk for you, as it is for me, you could consider the likes of Standard Bank with a mix of emerging and frontier market earnings. Only around half of group earnings in the latest period were generated in South Africa, with the rest coming from Africa and the offshore businesses. This gives Standard Bank an interesting risk profile that can do really well when the macro story in Africa moves in its favor. while having the South African business as an anchor that, in theory at least, reduces volatility in overall group results. But is South Africa really a lower risk market? Depending on the valuation at the time of entry into a position, the market can still throw you around like a rag doll in an otherwise steady stock in perhaps a steady market, in theory at least, like South Africa. Nedbank is a helpful example, with the share price down 17% year to date, and now trading back where it was before the election that led to the GNU exuberance. Although Nedbank itself isn't exactly seen as an innovative market leader, the troubles it faces in South Africa aren't even unique to its business, which brings us back to that macro point. For example, we can look at Standard Bank again as a relative play of South Africa versus Africa. The latest results at Standard Bank reflect loan growth of only 5% in South Africa versus the Africa regions at 13%. There are pockets of growth for Standard Bank in South Africa, yes, like home loan payouts, but the overall story is one of much faster growth in the rest of Africa than in South Africa at the moment. And a further benefit is that the growth areas in Africa are higher margin businesses than in South Africa, which is doing wonders for the overall Standard Bank business. Interestingly enough, Nedbank is doubling down on South Africa despite the macro story. The bank is choosing to sell its stake in EcoBank for 1.8 billion rand, with that news hot off the press. If they are going to pull back from Africa and remove that growth optionality from the group, then they will need to deliver a hot growth plan in South Africa that goes well beyond just the deal to acquire payments business iKhokha for 1.6 billion rand. And of course, by choosing to focus on South Africa, Nedbank is coming up squarely against the gorilla in the room, which brings us to another important point. Yes, the best companies can still buck the macro trend. In the banking sector, company performance is even more closely tied to the macro picture than it is in many other sectors, but despite this, Capitec put out a trading statement in the past week that reflects expected growth in HEPS for the 6 months to August 2025 of between 22% and 27%. This is an example of a company that continues to do a superb job of winning market share rather than relying on macro elements like interest rates or stable currencies for growth. The Capitec share price is up 19% year to date, despite the macro rather than because of it. If you came into this year with 100 Rand in each of Capitec and Nedbank, you would now have 119 Rand in Capitec and 83 Rand in Nedbank. For that 83 bucks to play catch up to the 119, Nedbank would need to produce a rally of 43%. This shows us that when picking stocks, you either need to make sure that you move with the macro factors rather than against them, or you need to pick companies that are so impossibly strong that they perform despite the macro. But on a risk-adjusted basis, I would argue that the latter is much harder to aim for. The former may be fraught with data that tells conflicting stories, along with all of the whims of politicians and how that affects things. But you can also just look around you and read company updates for clues as to where things are going on a macro basis. There have been many signposts along the way this year that have shown you the direction of travel in not just Africa, but in South Africa as well. Congratulations to those who realized that in 2025, it was time for Africa, and especially those who expressed that view by buying MTN. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.